The only things that I've received in terms of questions from some of the newer guys who are looking at the Fastball XRV is, when should I cut off the trades? As far as when should new trades no longer be entered, and that's a matter of preference. So for me, I'll leave those orders out there over the course of the session because one of us is always in the office. If you're going and what just happened there? Something happened to the room here, guys. Hold on. If hold on one second. Just let me. I really don't know what the heck just happened. Okay, so the question was, when should I cut the orders off? And what I was answering just then was, for Julie and me, typically, we'll leave those orders on for the majority of the session. We only really talk about the first hour because that's when, most of us are actually looking at trading these things. The first hour trading stuff is nice because then you're just over and done. If we're leaving the house or something, we definitely cut those orders off. But for the most part, it's like if they go in the first hour, they tend to be the best. But over the course of the day, they can still wind up at a profit target. So that happens probably, 2 or 3 times a month that, something triggers late in the session or we get a big gap open and then, the stock just sort of drifts around and we don't wind up getting triggered in until 11 a.m. Pacific time. And, lo and behold, over the course of the day, it goes to the profit objective. But if you're cutting them off at the first hour, I would really suggest the first hour and a half, so that you'd be going until about 11 a.m. Eastern. That usually winds up catching the bulk of, what's going to be a good trade. So, yeah, like a circus going on here today. I got sirens and, but nobody else had real specific questions this week, so I think the video helped. If you haven't watched that video yet, just go to your Fastball site. Hang on, I gotta share my screen. And if you go to the site and you go down here, you'll see a video that explains exactly how I use the setups and how I set my entries and my targets and stops and things. I'm gonna go over the stops and targets for the Monday trades in a second because I think it's gonna be a short webinar today, but at least we can go through and find these stops so that everybody's on the same page Monday morning. And then the other thing is, we've got this month-to-date and week-to-date thing here that's, this will zero out, obviously, on Monday. That is going to go and show you, where we are on a day-by-day. And hopefully what you can do there is get a feel for, how a week is skewing. So in the case of this last week, as you know, Monday was the day that most everything wound up booking a profit. And in the case of the week to come, just expect it to continue to slow down because we're getting into late August, we're approaching Labor Day, and historically this is going to be one of the slowest weeks of the year. But let's take a look at, okay, we've got five below, and iRobot. So let's have a look at those and see how we would set those up for the trading plan for Monday. All right, so Eric is asking how the pivots and the support and resistance are calculated. So we can get into that in a second here too. So let me just show you. Let's do this. Let's do it this way. Your 5 below, you can see that on the intraday chart, on the 5-minute chart, right, you've got a lot of, it's $108 and what? 108.81 was this. So 109.01 roughly is going to be where we're looking to get in. And I say roughly because, you know, it's sort of a range. And then I'm going to set my stop initially down here at 108.33. So why am I doing this? You know, I might tweak a little bit, just a little bit lower here at 108.31. So that gets me below this big volume push going into the close and also below this bump. The next place that I would assume I needed to go for a stop, if I wanted a wider stop, would be down in here, 107.72. And then a good habit to get into is to measure, right, where's your volume weighted average price? Now, you know, I'm sort of eyeballing this, and I can just tell that my VWAP is going to be up here, 108.45. That's based on this last big move of the session. If you take the entire session, of course, you're going to be down further. You're going to be down into this range. So then 107.72 makes for a better stop based on that. But, you know, I like to use the last big move of the day. So tighter stop is going to be 108.31. We're sort of going to see what the futures are doing on Monday morning. A wider stop that catches the whole thing would be 107.72. And then what you like to do is look at these pivots. And you'd have to be all the way down at 107.58 to be below the central pivot. Now, the central pivot is calculated as the high plus the low plus the close divided by 3, okay, of the current session. So what you're doing to calculate floor trader pivots is really just, you know, it seems a little arbitrary, but what it is before we had charting software, right, guys like me were calculating the value zones by doing exactly this, high plus low plus close divided by 3. So the guys on the floor of the exchange were taking a hard value, an average value was going to be the central pivot, and then to calculate, let's just do S1 and S2, Eric, those are the targets typically, right? So for a long, your target is going to be that first resistance at 110.05. And the way that you calculate first resistance, and you'll love this because this is, you know, an industry-wide standard that's been used for 100 years, and people still use it, but the R1 level is going to be 2 times the value of that central pivot minus yesterday's low. So 2 times 107, or 2 times 107.58 minus 105.11, right, gives you 110.05. That's first resistance. And second resistance is going to be 2 times the central pivot minus yesterday's high. I'm sorry, first support rather. First support is going to be 2 times the central pivot minus yesterday's high is going to give you 106.17. So 2 times this number minus 108.99 gives you 106.17. And those are the numbers that you're really worried about. And then, you know, S2, if you care, is just the central pivot minus yesterday's high minus yesterday's low. And R2, the second resistance, is, I think, is central pivot plus the quantity yesterday's high minus yesterday's low. So you can find those formulas in your software. You can find those formulas, you know, I'm pretty sure they're in the Income Trading Academy too, but that's how those are calculated. So in the case of 5 below, we're going to target, right, the initial target would be 110.05 unless there's $1 in profits first. So from 109.01 to 110.01 is what we're going to target, and the pivot is going to be at 110.05. So I like it when they work out that way, that the pivot and the target wind up being close. So target and pivot, right? Pivot's going to be 05. So they're clustered. So that's going to be 5 in the morning, and then the first thing that I'm going to look to do right after the opening bell is there a way to get the profit or to get the stop loss up tighter on this one? Can I move the stop up into this closing range, or right on top of this closing range? And that's based on the morning price activity. So if we get an open that opens right in line here and then starts climbing higher, I'm going to get my stop loss ratcheted up really tight. So at the open, those stops are pretty wide, and they're pretty, they make for a loose kind of a trading experience. But very, very quickly, you hear me talking in the first hour trading pit about the fact that I'm tightening the stop up. Looks like somebody else had a question. Hold on. Screen sharing disappeared. Let's go back in here and fire it back up again. Okay, so let's try this again and make sure that everybody sees it. So what I was saying was I've got 108.03 is the first place that I'm drawing get these lines out of here. This is support and resistance based stop. The second place is 107.72. The entry is 109.01. And the target then is 110.01. And when I went and did the volume weighted average price, I'm sorry that blanked out on you guys. Volume weighted average price of the last major move of the day, right? That's basically from this level down here into the close. That gives you a VWAP up in here. And then if you did the entire day, that puts you down in here. So the lower stop was going to be better. And then, if you did this other move, that gave you a VWAP up closer to this stop out, right? So 108.31. So 108.31 is the level that I'm going to go with. And now let's do iRobot. All right. So when you guys are looking at this, the iRobot stop should be pretty obvious, right? You've got an entry on this one, going to be up above about 95.09. And then your stop, you can either go right in here, or you can dip below this even and catch the entire swing that this took. But I'm really looking at right into this level here. So about 94, right around 94 bucks. And then once we open, I'm going to look to pull this stop up into this level here, up into the closing range, where if it comes back down through that through the entry criteria through 95.09, then I'm going to look to get a stop as close to 94.80 as I can, and that's going to be based on what does it do on Monday morning with this volume right here. So is it going to come back down from above and bounce off this level? And if it does, then we're going to use a stop that's going to be just below where it bounced. And if it doesn't, right, if it opens in here and starts traveling up, then we're not going to start adjusting stops at all. We're going to wait and see where does it have an inflection in the morning. But those are sort of the two lines of action that we're going to take. If it opens in the range and travels higher, we're going to keep the stop on. If it opens, travels up, finds support right here, which I suspect it will if it goes higher, then we're going to use this level as a stop loss once we're in the trade. But when the trade's initiated, we're going to have a pretty wide stop and allow it some room to swing. Pivot on this one, $92.76, and first resistance is 97.08. So 92.76, that stop would be way down here somewhere. So 76 is the pivot. So really you'd be looking at, to catch support and resistance, you'd be all the way down at 91.72. So that's a no-go. So we're going to use the support and resistance stop up there. Again, if you want to do the VWAP, you should be able to sort of look here. Who thinks the VWAP on this is going to be, all the way up here or somewhere down in here. So the VWAP from here to here, right, is in that stop range. So why is that? Because volume weighted average price is you take each tick, and a tick that has 1,000 shares has 10 times the weight of a tick that has 100 shares, and this average is calculated then by which price had the bigger ticks. And in terms of our target, right around $96 and actually 9 cents, so about $1 from the extreme of the prior session. That's because this value, 97.08, is greater than $1, so that's $2. And if you are looking for the pivots, so I know Goran doesn't even fool with the dollar targets. He's looking for a pivot move on every single one of these, and he gets it quite frequently. But I think sort of good practice is if it gets to $1, take off part of the position, and then if you're looking for that pivot extension, just look for the extension on the other half of the position. So you can load up, if you're doing a significant number of shares, let's say for the sake of argument, you get 1,000 shares on, you take 500 off at the $1, and then you take the other 500 off at the pivot. At least that way you lock something in, because very, very, very frequently, $1 winds up being the maximum excursion that this thing makes before it comes back down and hits that entry price again. In Goran's case, he's just leaving the stops on all day and the targets on all day, so he's giving them a lot of room to swing, but that's because he's not sitting there staring at them. All right, so who's got questions, like general questions about XRV? I see somebody's typing there, so I'm going to hold off a second. Otherwise, we're going to have a short webinar today. I was very surprised that, well, I'm not surprised because judging by email opens and everything, people are getting a little bit random here in August about when they're going to trade or when they're going to look at this stuff. So I'm just assuming that everybody's in the same mindset as Wall Street is, and that's between now and Labor Day. They're just really easing off the pedal. All right, so everybody sees the logic then. I mean, that's all I really care about, is that you understand why I'm putting my stops where I'm putting them, right? I don't want to just be in the first hour trading pit and say, okay, I've got to stop at such and such, and not have people understand why the stop is there. Target is a no-brainer, right? Just $1 or the pivot, whichever comes first. Entry right above that line. Excuse me. Watch the video. And get a better sense of it. If there's something you don't understand on the video, let me know, and then I will add it to the video so that everybody has a good understanding of how everything's going. Julie is currently rewriting the rules for the around the horn trading plan to make that easier to understand. Okay, so that's a good question. I don't know if you guys can see Eric's question there. Seems like trading is based on following institutional traders and following or jumping in on some of the action. Can you explain the opportunity for a day trader in general? What's he doing? What are you doing? So your purpose, of course, is to earn an income, right? So your purpose is to go in and get paid for providing liquidity. So providing liquidity is what the intraday trader is doing. So everybody who's on the floor of the exchange, right? All the $2 brokers, all the floor traders, everybody who's down there, those are all day traders. Those are all guys who are, they're not buying stock and taking it home overnight. They're simply there to provide order flow and liquidity for the market, and the reward for that is, right, as they're buying and selling the order flow over the course of the day, they're getting paid. A $2 broker, nowadays gets paid $1 per 100, not $2 per 100, but is getting paid based on the number of shares he transacts over the course of the day. And then, of course, he's got additional reward if he goes in there and he buys low, sells high. Then he's got the opportunity to have a net number at the end of the day that's earned him a profit as well. So you're doing pretty much the same thing. You're providing liquidity to the equities market. So if there were no traders in and out over the course of the session, then liquidity in the markets would be pretty dramatically affected. And that's the value that you add then to the market. And then, of course, you also get compensated for that value in terms of, you get rebated on trades in which you provide liquidity. So in my case, if I'm going to buy a stock, usually I'm going to bid for the stock. That's providing liquidity. That gives me a rebate that earns me, typically on a larger order, you can earn your commission back on the way in, and you can earn your commission back on the way out. So if you have an order to buy and you bid the stock instead of hitting the offer, right, or lifting the offer, so if you go and lift the ask, then you've taken liquidity away from the market and you pay. And if you provide liquidity, if you put a bid in, let's say that on Monday, iRobot opens, trades up at 95.09 and then goes 95.10, 95.15. So let's say your order's at 95.09. Then what you're doing is you're providing a liquid market at 95.09. And if price comes back down again and hits that level, you're going to get a reward in terms of a commission rebate because you've provided liquidity to the market. Market needs liquidity. If you read your agreements with your broker-dealers, usually there is a liquidity clause in there that pretty much just says, you want to trade for free, go ahead and provide liquidity to the market. And, what happens is then, NYSE or NAS is going to give you a rebate based on the size of the order and how many shares you provided liquidity for. So, yeah, in terms of what the institutions are doing, that depends on who you're referring to as an institution. So in the case of the fastball trade, right, the XRV trade, that institution is usually just somebody who's looking to get an order done. So we're just jumping on the coattails of the big order flow, and then typically the next day that order flow gets exhausted. So you've seen this a million times now, where we're just getting in and catching a little piece of, here's an institution that is, trying to get from whatever share size they currently have to whatever share size they're going to want. And over the course of the session, they're very heavily biasing whether or not they're willing to buy additional shares on where the VWAP currently is. Where's the volume weighted average price? Because that's how those guys get paid. They get paid on the VWAP. So they're putting together an order. They're trading for the institution. End of the day, it's what was the relationship of the price that I got for the institution, what was the relationship between that and the volume weighted average price that the stock traded at for the day. So if the trader for the institution went out heavy at 94.80 and the volume weighted average price for the day was 92.50, then institutional trader is not going to be so happy with what he did. And the next session, what he's going to try to do is, if this thing starts moving again, he's going to try to get in early and put the pressure on the stock. That's where you see that bump that goes in our favor, is he's putting the pressure on the stock again, because now he wants to get as close to yesterday's VWAP as he possibly can, and he wants to be as low in comparison to today's VWAP as he possibly can. So that's where he's going to be buying, and that's where we're going to hop on and just pull some profits out of the market as the stock's trading. In the case of the NASDAQ scalper trades, the institution in those cases is a high frequency, they're HFTs, they're called, so high frequency trading algorithms that are run by hedge funds and different institutions that go in, and they're trading those super cap stocks, and they're just looking to capitalize on volatility bands that the computer can identify and say, these are the places that Apple, for instance, is likely to inflect. So, in our case, we're just going in and we're looking at Apple and saying, these are the volatility pockets that occurred over the course of the day, and then within those, right, are the narrower volatility pockets. And what you're doing in this case is you're hopping on what's, generally speaking, high-frequency trading activity, where the institution is earning revenue for its clients just by in and out and in and out over the course of the session, just bouncing these bands. So they're just getting in, at the low band, getting out at the next band, in, out, in, out. And, that stuff happens in milliseconds. They are co-located at the exchange. They have, their server is sitting, right there in at the data center, at the NASDAQ data center in New Jersey, and they're just, they pay for server space because what they want is the fastest possible connection. They're just going to look to, cash in and out of these trades as fast as they can. And that's exactly what you're trying to do then too, is identify where are these things, and when you find them, right, you're going to replicate what an HFT does. It's just your bands are a little bit tighter than the HFTs. So usually our bands are about 20 cents, and we're trying to catch, again, sort of the middle of that move. And then on the around the horn stocks, that really is about providing a liquid market. So those are NYSE stocks, and as you look at those over the course of the session, right, they tend to be trades that happen over the course of 3-4 hours, and really what you're doing is you're going in and you're making a market in that stock between point A and point B, and you're trying to profit from this sort of bigger picture swing move that's going on. You're putting your support and resistance lines just about where the specialist in the stock is putting it. So there's one specialist, right, one designated market maker for each New York Stock Exchange listed security, And for the around the horn trades, you're trading it very much the same way that he is. Right, you're providing liquidity because you've got an order. So, take it and put it in some other concept for yourself, right? If you are if you're a car dealership and you don't have any cars to sell, right? The guy who delivers you a truckload of cars has provided liquidity to you, right? And in the market, you're providing liquidity. The market maker is obligated to provide liquidity. That's the law. So if they want to make a market in stocks, they have to guarantee that they will buy and sell. They will make a liquid market in the stock so that the U.S. equities markets don't have giant vacuums in the price levels that you can buy and sell stocks. So if you're the market maker, you're on the hook. If you're the specialist at the New York Stock Exchange, you have to guarantee that if you're the guy who's responsible for trading IBM, or you're the guy who's responsible for, trading Harley Davidson or Michael Kors or whatever it is, you guarantee that on any given day you're going to make a market, you're going to provide a liquid market in that stock. And that's exactly what then individual traders are doing, just on a smaller scale. So your specialist in the stock is the buyer of last resort, right? That's the way that it's termed, buyer and seller of last resort. So he's got to provide a point where he's willing to take in stock even if the stock is plummeting. He's got to be willing to buy shares so that there's not a free fall. When you come in as an individual trader, you're doing the same thing, just a much smaller scale. On the other hand, if you're buying the stock and you go in and the stock is bid at $50 a share and the ask is $50.10 a share, and you decide, I want it, I don't want to take the chance that I don't get filled at 50, I'm going to go and buy it at 50.10. At 50.10, you've taken liquidity away. So you've taken a level that there was a guaranteed seller, and you've snatched it up, right? So now the next price is, let's say, $50.20. By taking away the liquidity, you've gone and caused the market to move its liquidity pool higher. Okay, so you've taken the liquidity away. Sort of a general good place to start is just take a look at that stock trading 101 thing, and that should be in your, if it's not on your dashboard, I'll put it there so that you can sort of get a feel for the background of the markets, as you're going through your boot camp stuff and your income trading academy there. Then I think it kind of helps. It helps to keep in mind this all started under a buttonwood tree, and those guys were traders. Those were the first traders, and then it moves up to the point where it's institutions doing this stuff. But it's always been the same thing. It's just a market. Really, this is no different than buying and selling produce, right? If you're buying oranges and you're looking to make a market in oranges, then that's very different than being an investor in an orange grove. If you're the guy who's running the market, you have to calculate, all right, well, what's the best price that I can buy these things in at? What's the best price that I can get for them when I'm selling them? And, how do I price them so that I'm not sitting on a bunch of rotten oranges at the end of the week? And that's pretty much exactly what you're doing here, right? You're just trying to figure out, if I buy the stock here and I'm planning to sell the stock at a higher price, what is it about the behavior of the stock in general right now that tells me I've got a higher probability of getting to the the price that I need to get for it than winding up with the rotten apple. All right. All right. So anybody else? Okay. So again, if you're new and you are looking at this stuff for the first time, I encourage you wholeheartedly, don't just retrieve the trading plans from that email every night, right, where you're clicking on the thing and downloading it. Go to the site, go to your members area, and I'm in the admin here, so it's going to take a second. All right, if you go to your account, and you go to, let's say, go to the Around the Horn plan. It's really going to help you to, understand the ebbs and flows in this thing by going through these archives, right? So if you pull up the archives of the plans, so say you just randomly pick, 2016, and then you pick, a day, whatever you pick, and then you can go and pull up that plan for December 15, 2016. I stopped sharing the screen, didn't I? Here we go. So if you go to the site and you log in and you go to your service page instead of just downloading it from the emails, right, then you can go, I was saying, you can just pick a day on the archives, right, 2016, you pick, whatever day you want to pick. Oh, December 28th. Okay, so here were, the setups that occurred on that day. And, this is before we were identifying the confluence numbers and everything over here. So you just take a look at the setups, and then, you can go and compare the setups. December 28th, right? You go back in here, and you can also pull up the spreadsheets. So these show you how every day of the trading plan acted all the way back to 2006. That shows you what would have happened if you were trading So if you were trading the first part of the trading plan called the Around the Horn trading plan, here's the explanation of what each one of the trades is. Where would you have wound up? Right, for the year, where would you have wound up on December 28th, right, was the day we were looking at. So you go through and you look at this, limited brands, that was a backdoor slider, it was a short, it triggered, it shows a 0. What's the 0? 0 means it made it 50% of the distance to the profit target, and our exit was at 66.11. So the entry was 66.11, exit was 66.11. And you can go through for each one of the trades on the 28th. Right, you see there was another one in Shopify was a 0, that was a break-even exit, and then VMW was a 41 cent per share profit. So you got in at 79.79, target was 79.38. 79.38 was the exit. Okay, and then you go over here and you look at these charts, and what this shows you is how many times did each of the patterns trigger for the month, or how many times was the pattern identified as a potential trade, and then how many times did it trigger. And what I like to look at on these first two charts is the distribution skewed, right? So did I identify, 80% of the trades as being fastballs, but only, 20% of the trades that were identified as fastballs triggered, because that tells me I'm introducing a selection bias, and that's something we don't want to have happen. But, here we see it's a pretty smooth. We expect fastball to be the biggest part of the distribution. That's just because it's the start of the cycle. And then in this case, we see infield fly, which is a reversal pattern, right? It was the second largest portion. And when we go down and we look at the distribution of triggers, we see, 37 versus 28, 15 versus 10. All right, makes a lot of sense. Double header, the reason there's more triggers than there are setups is that these were second entries. So that would be if it comes back up or it goes back down below our entry price, and then it goes 8 cents beyond the entry price, we reset the trades. So that just tells you, how many times that particular pattern either stopped out or gave you a profit objective and then a second entry, or a 50% to target and a 0 and a second entry. And then when you really want to dig into it, you go down here and you look, oh, double header, okay, $2.14 in profitability. So comparatively speaking, double header was second to infield fly for the month. And these are really nice then, just statistics to go through and evaluate in terms of, how would I have done if I was putting these trades together and automating them. So there's the around the horn portion of the plan. So this is trading them strictly by the rules. Where would you wind up over the course of the month, over the course of the quarter, over the course of the year? And then when you get into this asset allocation stuff, I don't really like this all that much, but it's the way, some people want to see this presented. I look at my overall profitability in terms of points per share, dollars per share. So the gross dollars per share, that's just $7.11. And then how many shares are you trading, right? So, you just multiply it by that number. That gives people a lot of consternation. They want to talk in terms of, return on account, or percent return on account, or leverage return on account. So what I did here was, where you see 1-to-1 in a $50,000 account, that implies you use zero leverage in your account. And when you use zero leverage, all that would mean is if there are 5 potential trades, then you divide the $50,000 in an account gets divided by 5. $10,000 gets applied to each one of these trades. So what this tells you then is you would have 202 shares for a 1-to-1 levered position. You would have 154 shares of the second trade for a 1-to-1 position. You would have 155 shares of this third trade to go 1-to-1. 2-to-1 would be 310 shares, okay? And you're just multiplying this number by the amount of leverage that you're applying. Now, practically speaking, anytime you're trading intraday in a PDT account, you're getting 4-to-1 leverage on every trade that you put on. So if you're buying a $100 stock, you're only putting up $25 per share traded, and that's just automatic. They automatically are levering the account. So, people like to start small and think that they're not using any leverage, but it's just a nature. There's another one of these things you just have to wrap your head around. The nature of trading or investing is that you always have more capital available, right? In a regular investment account, you've got 2-to-1 leverage available. So when you buy $1,000 worth of stock, you've put up $500. You still have $500 worth of margin that you can that you can invest with. In the case of an intraday account, if you have $1,000 in the account, you've got $4,000 worth of margin available to trade with. That's not the same as risk. Risk is strictly based on how much risk is there in any given trade. So if we buy 400 shares of this stock, we're 4-to-1, right? If we buy, I'm sorry, not 400 shares. If we buy at $403.85 is what we're allocating, right, to this, to HDB. Our risk is not that 4-to-1 margin. Our risk is the travel range between $64.38 and $64.89. Follow this? So you've got 49 cents of travel range between your stop loss and your entry price. That's your risk. So your risk is going to be $0.49 times 400 shares in this case. That's what this is figuring out, because you're not going to have 403.85 shares, right? This is just figuring out based on based on this number multiplied by 4. I'm sorry, I'm backwards here on this thing. If you multiply your share size by 4, right, you're going to have some discrete number, and if you multiply it by 4, this is your total risk is going to be share size times the distance from an entry price to a stop on any one of these things. So your risk is not ever the dollar value in your account or anything. Your risk intraday is the finite number that you establish for the trade. All right, but these are really good tools to go back through and look, because you can go and just get a feel for how these different parts of the trading plan behave, right? What was your return, 1-to-1, 2-to-1, right? These columns are how much came in based on this move, right? So it was an infield fly. It gave you 46 cents. 1-to-1, you made $92. 2-to-1, $185. 3-to-1, $278.96. 4-to-1, $371.94. Or if you were just trading fixed share lots, then right, 1,000 shares would be $460. 500 shares are $230. I mean, that's how this sheet comes together and works for you. But it's a real good place to go and look. And most people, they never go dig around in the site. So don't take all this stuff for granted. Go through and see. You can go through and analyze these numbers and sort of rethink these numbers and figure out how they work in your head and how they work for your trading, and how the stuff performs in general. And you'll see this around the horn thing, right, is really about the cyclicality of the markets and markets moving through these patterns over the course of the year. Right? So how does the market move from expansion to contraction to the pullbacks, right? It's all about going through accumulation and distribution and then markup and markdown. But how does it behave in each one of those cycles? That's what this around the horn trading stuff is really all about. All right, you guys. Well, hopefully, hopefully it'll pick up a little bit this week. It's like I said, it's going to be late August. There's nothing we can do about that. There's absolutely no way to alter that fact. So I'm going to continue to use smaller share size. So for me, I keep the share size pulled back this time of the year. I've had it pulled back all of August. I wish in hindsight that I would have had a full block of shares every day, because it really wound up being a good month. But then it's very typically the case that in August the liquidity is hard to come by. And you go out looking for 1,000 shares, and you price out to get 1,000 share fill, and then you turn around and you get 437 shares or 637 shares. So it's a little bit easier just to keep the share size lower. I've been trading 500 for the last couple weeks, and just spreading it between all the different trading plans. Whereas during the busier part of the year, I like to load up heaviest on that XRV thing because it's over in the first hour, and it just sort of suits my personality. But we'll see here what this week brings. All right, you guys, have a great rest of your weekend. And if if anybody has questions, then you know where to get me. You can send me a text at 310-804-2248, and I will be happy to just shoot you back a text and say, hey, 15 minutes would be a great time to talk, or whatever, and we can go through it. All right, folks, have a good one, and go enjoy your family and or your weekend or whatever it is that you want to do, and I will see you all on Monday morning.